People always say that, well, I don't have liquid capital to go do this particular investment when I get approached to go do a real estate deal. But this is someone who may also have $750,000 in old 401ks, which are now in an IRA at Fidelity, sitting in three index funds and in four tech stocks, for example.
Right. Now, is there some, I guess, considerations in terms of how they can leverage retirement funds, whether it's 401k, whether it's an IRA, in investing in private equity? I know there are prohibited transactions, certainly,
Mhm.
but are there other considerations that you would counsel your prospective investors when they're leveraging those 401ks, those IRA accounts?
Sure. Well, one of the best things to do is actually to go in and invest with a syndicator or someone who appropriates funds in a cluster. Because if you're a passive investor in a private equity fund, or let's say a syndication, which is going to be used to purchase a multifamily real estate project, I'll just use that as an example. If the particular deal sponsor, so in this case, it could be an organization like yours, chooses to use leverage to be able to buy a $10 million property with $5 million down, for example, some of which would be coming from the syndication investors, the LPs. In that case, any investor using an IRA, because they're passive in that deal, is able to participate even though the deal itself is using leverage. So you're not the one directly using that leverage. So that I actually tell people that the syndication does a couple things, and we're going to get into that. But since one of the topics is capital preservation and or minimizing risks, it's that by going into these syndications, you can do many more deals as opposed to doing one big deal on your own with 50% of your old $750,000 in old 401ks. That'd be risky. And then if you did that by yourself and you were also running that deal, you would not have the ability to borrow any money. So let's say you did 375,000, half of that, half of the 750, you would only be able to purchase a property for $375,000, and that's probably not going to allow you to get a multifamily project. But if you did, let's say, five deals for $50,000 each, or six deals for $50,000 each, you would deploy $300,000, less than 375, so not even half of your account, and you'd be able to do six $50,000 units into different deals. And four of those deals may be in real estate, two maybe in oil and gas, and all of them at the deal sponsor level could be using leverage. So you're kind of amplifying your money, spreading out the risk somewhat into different particular deals. And in any one deal, you don't have more than $50,000. And the reason why that's important is that I don't think about deals going into them as like a complete loss of capital type of situation, but I do think about it as maybe the more realistic scenario, because the reality is that a small percentage, a very small percentage of deals may go completely away in terms of your 50,000 goes to zero.